Hello everyone, welcome back to Mindful Investing and to the 15th stock in my stock prediction series where we mix data, fundamentals and technicals to forecast both short-term and long-term price targets. Today we are talking about Dutch Bros, ticker symbol BROS. The stock is already up 20% year to date, and after reporting their earnings this week, the stock is up another 7%. So in this video, we'll break down what they do, where their money comes from, and where the stock could be heading in the next 1 year and 5 years. I'll also show you its technical chart, the key support zones, and whether I consider it as a buy or not at these levels. And I understand many viewers are primarily interested in price targets and may want to skip the business model discussion. But having a clear understanding of how a company generates revenue is essential when making long-term investment decisions and investing our hard-earned cash. So I encourage you to stick around till the end, and if you find value in this video, please give it a like to help grow the channel and drop a comment with the stock you'd like me to cover next. Alright, let's start with the basics. Dutch Bros is a rapidly growing drive-through coffee chain that operates in 29 states with majority of its stores in the western US. Unlike Starbucks, which has a cafe-first model, Dutch Bros is all about speed, convenience and community-driven service. Their stores are almost entirely drive-through only, making them lean, efficient, and perfect for scaling. They focus on energy drinks, coffee, teas, and cold brews, and they have built a loyal following, especially among younger customers. Their brand is very culture heavy. Think of it as a lifestyle wrapped into a coffee cup. Now let's talk about how they make money. Dutch Bros generates income from two key segments. The first one is their company-operated shops. These are the locations run directly by the company. In the trailing 12 months ending March 2025, they brought in $1.24 billion in revenue. That's a 33.4% year-over-year growth. They also accounted for $277.15 million in gross profit, which was up 34.76% year-over-year. And the second segment is their franchised shops, which are operated by franchisees. These generate recurring revenue through royalties and fees. This segment added $116.9 million in revenue with a growing rate of 5.6% year over year. And as of Q1 2025, Dutch Bros operates a total of 982 shops. Of them, 670 are company owned and 312 are franchised. So the majority of new growth is clearly happening on the company-owned side, which gives them more control over margins, operations, and the customer experience. But it also means higher capital requirements. Now let's look at the most recent earnings and some key metrics. Their expected trailing 12-month EPS is 39 cents. The expected annual EPS growth rate is 32%. The current PE ratio is 164.24. This looks to be definitely elevated, so we have to wait and see what kind of growth the market is pricing in and whether that's sustainable. And finally, we have the current stock price, which is around $63. Using these numbers, we get the 1 year price target of $84. That's a 33% upside from today's price. And the 5-year price target is $256. That's over 300% potential upside if the valuation holds up. But here's the thing, will the PE stay that high? Well, as the company matures, PE typically compresses. If we apply a more conservative PE of 50 in 5 years, that gives us a price target closer to $78, which would only be a small gain from today's price. So the outcome really depends on growth execution and investor sentiment staying strong. Now let's look at their charts. The stock is currently bouncing off its 50-day EMA, which has acted as a short-term support in the past. Coming to the major support levels, $51 is a solid intermediate support. And then we have $30, which is the longer term level from which the stock has bounced multiple times. I personally think building a position below the 200-day EMA, which is around $50, gives you a better margin of safety. That's where I'd be looking to accumulate for the longer term if the stock pulls back. So is Dutch Bros a buy right now? For me, it's a cautious yes. I don't own any shares right now, but the business model is solid. Their revenue growth is strong and the brand has long-term potential as Starbucks competitor. But again, PE ratio is a concern. 164 PE ratio means the stock is priced for perfection. Any slowdown in growth could cause a valuation reset, and that's something to keep in mind. I wouldn't call it a screaming buy right now, but I do believe Dutch Bros is a buy on dips, especially if it trades closer to its long-term moving averages. And remember, these estimates can and will change every quarter depending on earnings, macro conditions, and sentiment. So I'll be back to reevaluate after the next earnings report. Let me know what you think in the comments below. Do you own Bro stock? What's your price target for the year end? And don't forget to like, subscribe, and hit the bell icon so you never miss a forecast in this stock prediction series. Thanks for watching, and I'll see you in the next video.